Welcome back to the Fundamentals of Climate Change and Economics, Part 4. Now, in this lecture, main objectives would be covered as to understand the tradable permits, to visualize the determination of carbon permit prices, then to understand the national permit system, to know the advantages of carbon tax and cap and trade policy. The second type of market-based instrument, in the first half we discussed how the carbon tax were imposed, and which is one of the type of market-based economic instrument, environmental regulation instrument. So another type of market-based environmental regulation instrument is tradable permits. It is an alternative to carbon tax. It is a system, it's a tradable carbon permit, which is also called as cap and trade. The carbon trading scheme can be implemented either at the state level or national level, and it also can be included in the multiple countries. So international level can also be implemented. A tradable permit system encourages a least cost carbon reduction options to be implemented, as rational firms will implement only those emission reduction actions that are cheaper than the market permit price. So tradable permit system has been very successful in reducing sulfur, nitrogen dioxide emissions at a very low cost. Depending on the allocation of permits in any international scheme, it might also mean that the developing countries could transform, or they can transform the permits into new export commodity. So when you are trading permits, you can visualize as if you are trading a export commodity by choosing a non-carbon path for the energy development. So if you are trading any less carbon emission commodity, then in fact you are trading the permits. So it can be taken as a proxy for that. They would then be able to sell permits to the international or to those industrialized countries that were having that were having trouble in meeting their reduction requirements. Farmers and foresters who could also get the carbon credits for using this method, and they can store carbon in the soil and preserve forests. So while doing these activities like preserving forest and storing carbon in the soil, they are actually earning credits for themselves. So if you want to talk about the carbon permit price, how do you determine the trading permit prices? On one side, we have the supply of permits which are issued by government in the beginning, and it is fixed, say around Q0 quantity, and from the demand side you have the marginal cost. Marginal costs are on the demand side. So as you can see in the diagram, so the equilibrium prices for the permits are determined wherever the demand for the supply of the permits and the demand for the permits, they intersect each other. And that gives you an equilibrium price of permit and the quantity of permits. Now, there are various options in which you can reduce carbon emissions, like plant replacement altogether, then implementing the energy efficiency, forest expansion. You can have several numbers of it. These are different ways of reducing carbon emissions. Now, when you are talking about permits, you have a cost associated for buying permits. They are available at a price. So marginal cost generally rises as more units of carbon are reduced. So as more and more carbon is reduced by buying permits, the marginal cost generally rises, but then they may be higher and increase more rapidly for some options than the other. So all depends that what kind of a option you have chosen for reducing carbon emissions. So marginal cost will depend upon determinants of carbon permit prices. Willingness to pay for the first permit. Now the diagram which we just saw, it involves the demand and supply of permits. and permits is the permission to emit, your capacity, or you can say the permission or permit to pollute. The willingness to pay for the first permit you buy would be quite high, because that was willingness to pay is reflected by the demand curve of permits, that is the downward sloping. So the first permit you buy, the price is very high. For as a particular firm stands to make relatively larger and larger profits by being allowed to emit 1 unit of carbon. For the second permit, firms that fail to obtain the first permit would be expected simply to repeat their bids. So that is how the particular permit price P star is determined, that will govern the relative levels of implementation of each of these strategies. Firms will find it profitable to reduce emissions using a particular strategy so long as the costs of that particular option are lower than the cost of purchasing the permits. So the firm that successfully bid for the first permit could also bid for the second permit. You're allowed to bid for the second permit also if you have. So there are several ways of floating the permits in the market. We will shortly know about it and discuss about it. But right now you can just see the graph that how from one permit to another permit people are allowed to bid. This is the case of bidding we are proposing. There are other ways also in which permits can be floated. So permit could also be bid for this. A person can also bid for the second permit, but would be expected to bid at a lower amount, assuming that the marginal profits are declining with each additional permit you buy, because it's a cost. So automatically your marginal profits are declining. So selling price of this permit, represented by P star in the graph, is the market clearing price of permit market. We can also interpret P star as the marginal benefit or the profit associated with the right to emit. And what is the quantity that you emit? It's Q naught, the quantity on the horizontal axis, that is the unit of carbon emissions you are allowed to emit. Now, there are various schemes or permit systems. They are national, as we discussed, that they can be at a state level, national level, international level. So quickly we will go through what is the national permit system. A national permit system can function in the following way. Each emitting firm would be allocated a specific permission or permissible level of carbon emission. The total number of carbon emission will be issued would be equal to the desired national goal. So every country, as you know, because of the nationally determined commitment, NDCs in UNFCCC, so they have claimed the national goals for emission. So based upon that, they have already desired national goal, and based upon the national goal, they will issue permits. Total number of permits will be issued. Permits are allocated to individual carbon emitting sources. Including all carbon sources is difficult. For example, motor vehicles. So trading scheme is generally not practical in case of motor vehicles. So they locate and they identify the right kind of energy sources, emitting sources, where these can be applied or distributed. It is the most effective to implement the permits as far as upstreams are concerned. Upstream as the early stage in the production process. In the production process, where it is very simple to administer the program and cover most of the emissions. So the strategy is to implement these, or to these permits are distributed in the upstream, the early stage of production process. Permits could also be allocated to the largest carbon emitters. You can identify the carbon emitters in the society, such as power companies, which may be PSUs and other private companies, and manufacturing plants, and even further upstream to the suppliers. Now, suppliers are basically the carbon fuel suppliers. For example, oil producers, importers, then coal mines and natural gas drillers. They are all suppliers of carbon. So that can be implemented or allocated, permits can be allocated to them. These permits could initially be allocated on the free basis, without any charge. On the basis of the past emissions, you can distribute them, or they can be auctioned to the highest bidders. So there are ways of introducing or issuing the permits. The effectiveness of trading system should be the same regardless of how permits are allocated. Irrespective of how permits are allocated, either they are distributed freely or they are assigned or auctioned or through the auctioning of permits, the ultimate impact, or you can say the outcome, is not very much different, or should not be affected. Giving permits out for free essentially amounts to windfall gain for the producers or the polluters, while auctioning the permit imposes an actual cost on them. It will generate public revenue and generates the public revenue as well. Once you're auctioning, you're earning out of permits as it is. So firms are able to trade permits freely among themselves, and firms whose emissions are exceeding the amount of the permit they hold must purchase the additional permits. Suppose you're expanding your business and you need more permits to emit. So you will need more and you need to buy more permits, or else you will have to pay the penalties. Firms that are able to reduce their emissions below their allowances at a low cost will seek to sell their permits. If you have additional permits and you do not require them, you are free to sell those permits. The permit price will be determined through the market supply and demand, as we saw there. Then in the international system, the countries and the firms could also receive credits for financing their carbon reduction policies or the efforts. For example, a German firm could get the credits for installing the efficient renewable electricity generating equipment in China, replacing the high polluting coal plants. Suppose a German firm in China has replaced the coal plant by a more efficient renewable energy or renewable electricity generating plant, then German firm has earned credits out of it. Under the market-based instruments, we have there is a huge strong debate regarding which economic policy or which economic instrument should be used to reduce carbon emissions. Carbon taxes, as we saw in the last part of the session, that carbon taxes and cap and trade. This permit system is a cap and trade policy. They both have some similarities. At the same time, they have advantages and disadvantages. So quickly evaluating which one is better and which country. So it all depends upon which fits in the best for the country concerned. So different countries have got different experiences of these instruments. We will talk about those experiences in the next session of this particular lecture series. But right now, let us just compare the advantages of carbon taxes and cap and trade approach. Advantages of carbon taxes. In general, the carbon tax is considered to be simpler to understand and more transparent than the cap and trade approach. Cap and trade system is a little more complex and it requires bureaucratic institutions to administer. With the technological change that lowers the cost of carbon reduction, a carbon tax will automatically further reduce the carbon emissions. However, in the cap and trade program, the technological change will instead of reducing the price of permit, will probably result in some firms is actually they start emitting more. So that is the difference between the cap and trade. Technological, in case of technological change, it is the carbon tax which is giving a more efficient output in reducing quantity of emissions, while cap and trade, they end up emitting more. A carbon tax could probably be implemented very quickly. Given the need to address the climate change as soon as possible, it may be inadvisable to spend years, because it's the issue of time, and serious actions need to be implemented immediately. So it is more advisable to go for a carbon tax, because working out the details and implementation of cap and trade program, it's a huge task. Perhaps the most important advantage of carbon tax is that it provides greater price predictability. If the businesses and households, they know what the future tax is going to be on the fossil fuels and other greenhouse gas emitting products, then they can invest accordingly. Then, for example, whether a business invests in energy efficient heating and cooling system depends on the expectation of future fuel prices. So one can plan accordingly. However, in the cap and trade system, permit prices could vary considerably, leading to the price volatility and makes the planning difficult. A carbon tax, in contrast, provides a degree of price stability, specifically if the carbon tax levels are published years into the future. So one always uses the simulation and simulates the type of carbon taxes, carbon emissions would be there, and based on that you fix the taxes. So one can plan all the process of production and consumption from household and business aspects accordingly. So cap and trade system avoids the negative connotation of tax. One of the very important advantage of cap and trade is it is not a tax. So the connotation attached of tax, which is not there. So cap and trade system often generates a less political opposition than the carbon tax. So it's when the government agency puts a carbon tax, it is taken as a negative manner, and it discourages the voting process. Distributing permits for free in the early stages of production, cap and trade program can make a more politically acceptable to mainly the businesses. So one can gain the support of business sector also. The greatest advantage of cap and trade approach is that the emissions are known with certainty, because government sets the number of available permits. This is another advantage of cap and trade, because government already decides the national carbon emission policy and targets, and that is why the number of permits are already fixed. So one knows what target to be met. Shifting subsidies from carbon based to non-carbon based fuels, many countries currently provide direct and indirect subsidies to the fossil fuels. Now, there are other policy tools which we can discuss. One, we have already discussed the cap and trade and carbon tax policies, which are market-based policies. The other policy tool would be shifting the subsidies from carbon-based. So we already know that all developing countries have huge subsidized fossil fuels, and one, for example, coal. So the idea or the strategy should be to shift all the subsidies from the carbon-based fuels to the non-carbon-based, clean and renewable fuels. Many countries, they provide the direct and indirect subsidies to fossil fuels. If these subsidy expenditure were redirected to renewable sources, especially in the form of tax rebates for investment, it could promote a boom in the investment of renewables. So this subsidy shifting would be very beneficial. The use of efficiency standards for machinery and appliances and fuel economy standards for requirement of low carbon fuels. Now, creating efficiency standards is a very important aspect of policy tools. Now, suppose if those standards are created, So definitely the entire country, the production mechanism and the market will try to comply with those standards. Imposing standards in the favor of low carbon process will lead you to the low carbon pathways for transition. The other way of policy tool is the research and development, R&D expenditures. They should be promoted for commercialization of alternative technologies which are different from the conventional technologies. Both government R&D programs and favorable tax treatment of corporate R&D are for the alternative fuels or energy sources can spread the commercialization, the existence of the non-carbon economy. Technology transfer to the developing countries is another method of policy tool. The process is sharing the technological information of equipments, research and development, particularly among the low income countries and developing countries. Bulk of projected growth in carbon emissions will come in the developing world. So, all developing nations, the world across, have been under the process of rapid economic growth, and they have projected the growth process. So, the technologically advanced countries should tie up with them, and they should walk hand in hand in the process of low carbon pathways. Many energy development projects are now funded by the agencies like World Bank and regional development banks. So this is all regarding the various policies which can be implemented, the adaptive and preventive measures. Both adaptive and preventive measures are needed if you want to walk on the path of energy transition and carbon targets and meet the targets of carbon emissions. At the same time, within the preventive measures, we have two types of measures, which are carbon command and control measure. The other is market-based measure. Under the market-based measure, in today's lecture, we covered two types of tools, environmental regulation tools. First was carbon taxes, and the other was cap and trade. Under the cap and trade tool, we covered the tradable permits. A very remarkable example of tradable permits can be taken as EU ETS, European Union Emission Trading System. European Union Emission Trading System has been a successful system where it started in 2005 and it is running in the fourth phase of its emission trading system. Fourth phase from 2000, it's going on till 2030. So this is it has actually exhibited the remarkable effectiveness and efficiency of cap and trade policy, which is ETS system, emission trading system. However, there are several negative aspects associated with this trading system. One of the aspects of this trading system, as we have discussed today, is that earning the carbon credits. Earning the credits would mean that you show that this area is green and you implant, you give the certification that this area you have covered is under the green belt. And for that you take you have papers on it and you get the certification and show and earn credits out of it. So there have been several cases where, this trading system has failed because fake credits were given and allotted, and because of fake credits led to the wrong information and misinterpretation and misinformation being reported, and therefore the entire trading system broke down. And in other countries, there have been cases mostly in the developing countries where the politically supported trade systems were because of political economy, these systems these policies became a failure because they did not reach the optimum amount of equilibrium amount of emission targets which they were supposed to show, and the prices also failed. So the entire lecture was based upon the book of Harris, Jonathan M. and Brian, which is with the name of Environmental and Natural Resources Economics, a Contemporary Approach. And today's lecture was from chapter 13 of this particular book. In the next coming series, we will be covering the CAC, Command and Control Policy, and we will be applying both the cap and trade and CAC in different countries. We will evaluate both CAC and cap and trade policy. Their effects will be evaluated for both developed nations, and different countries will have their own experiences. So one cannot blindly implement these policies without seeing the situation of your country, without seeing the infrastructure, the governance mechanism, the administrative structure, and the institutions must be in the right places to implement these policies. So this was all about the carbon trading policy, and we will continue this series, that is the fundamentals of climate change and economics, in the next lecture as a part 5 and part 6. There are other readings, like I had mentioned in the earlier lectures, the reading of Kolstad. And Kolstad is a main key book for environmental economics, which talks about climate change and all the types of instruments and externalities. And this particular reading was only talking about the instruments in the detail. And the case studies of different countries like China, Russia, India, and US, they will be covered as far as their performance of different environmental tools are concerned. They will be covered in the next lecture in chapter 13 from the same book. So resource was going to be the same for the next lecture.